Adventure, you're 25, got all of the insurance Mass would offer you. Would you say that my parents are the best to expand your system of policies on? What would you look for when getting policies on parents? You can get a policy on your parents, but you're not going to be able to get a very large policy on your parents. One thing you might do is you could probably do a joint ownership with them and get a higher policy and get a higher amount, because the biggest amount that you can get is as an income replacement, as for death benefit, right? Now, were you limited from Mass based on your death benefit or based on your payment? Because that's a big difference. Mass Mutual wants to know exactly how much you're putting in. So you could get a big death benefit, but they're only going to let you contribute X amount of whatever your income is. So what was it that limited you? Was it the death benefit or the financial underwriting portion of it? That can make a big difference. But expanding your system of policies with your parents, it can work. But like I said, the key is you need to be able to qualify for a bigger death benefit in order to be able to in order to create large policies, right? Now, I don't know how big you're thinking that you would want it to be in order to expand. It might be that they would give you enough insurable interest with your parents that it would meet the needs you're looking to fill. But your insurable need with your parents is not going to be as much as their insurable need as an income replacement if they're still working. So the challenge is to determine your insurable interest. Death benefit. It's about a third of your income for your current policy. That doesn't sound right. A third of your income. So take your annual income, multiply it by 30. That's the amount of death benefit you should be able to qualify for. So is that the amount of death benefit you're at right now? So, Adventurer, Mass Mutual approved you for a payment of a third of your annual income as a premium. That's really good, because typically they don't approve that high of payments. Death benefit, well, maybe they only limited you to 25. You should have been able to get 35. You should have been able to, or 30. You should have been able to get 30 times your income. So you do still have some death benefit available. The challenge there is some companies will look at they won't be counting your death benefit as it's being applied for. They'll look at what it's going to be a few years down the road. So they might have approved you for 30 times your death benefit, but they're not looking at what your death benefit is today. They're looking at what it'll be in a few years. So maybe they did hit 30 times. Maybe they did hit 30 times your income, in which case you would be maxed out, possibly with Mass Mutual. But that doesn't mean you can't get more somewhere else, because you should, if you apply at, say, Guardian, we would apply and we would tell Guardian your current insurance amount is whatever it currently is, 25 times. So you could still get another 5 times your income with Guardian. And we could probably do that with other folks as well. Yeah, that makes sense that in a few years it would be 30 times. So when you apply with, you wouldn't be able to do it with Penn Mutual, because Penn Mutual also looks a few years out, but Guardian does not. So it's possible to do something with Guardian. But really, at only doing 5 times your income, you're not looking at much of an extra policy to be able to get. Once your income starts to expand, then you'll be able to expand your policies. In the meantime, yeah, good idea to look at your parents, but I would suggest maybe looking at a co-ownership of the policy with them. That way, with the understanding that you're going to fund it and you basically get control of it. They're just going to help you. They're going to help you to start it. and then you'll have a death benefit on them, and you'll have cash value that you can grow. I think that's a great idea. Great idea to get policies on your parents. You just got to make sure you have enough insurable interest. So if you don't do co-ownership, your insurable interest might be how much impact does one of their deaths have on your financial ability. And for a lot of folks, this is what we run into for kids or for parents or grandparents. It's burial cost. And often not much more than that. I mean, if you're living at home, maybe we can justify a little higher death benefit to maybe pay off a mortgage or something. But for the most part, the insurable interest is not going to be very high. So, adventure. That's an interesting idea. You like the co-ownership. Parents are definitely one of your millionaires next door, but I still do live at home. Okay, cool. Cool. Yeah, co-ownership probably going to work out the best then, because that'll be the way to get a big policy. Depends on how much you're trying to be able to fund it at. Maybe you can talk them into helping you fund it. Who knows? Right? That would be even better. Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.